So we have started our spring group mentoring program for members of the Options Tribe who want to be mentored by me personally. And it's a great format, by the way. It starts out with 4 traders who meet every 2 weeks for 2 hours. Each trader gets 30 minutes dedicated just to their trading, and then the rest of the time they observe as I work with the other traders in the group, each of whom are getting their own 30 minutes. And so it's a great format. The traders get to know each other. They get to know each other's trades, and I try to put groups together with different trading styles so people can get exposed to new things. And it's a fun format, and I think very, very helpful to the traders who are involved. And so this was our first session of the spring semester this past week, and one of the traders got onto the webinar and began to speak about his particular trade. And so this was a trade that was up on early February before the crash. It was up a couple $100, and it was trade was looking very good, as you can see from this example. And at that point in time, the trader decided to go on vacation. Now, while he was away on vacation, the market crashed, and he left his trade on. Did not have any real way of trading the trade, and he went from being up $600 to down $32,000 by the end of the day on February 5th on this same trade while he's on vacation. Now, he needed, for this trade to be profitable, he needed the market to rally, the Russell 2000 index, which is what he was trading this bearish butterfly structure in. He needed the market to rally 44 points before the end of the trade, or he was going to lose money on the trade. And if the market continued to crash, he had the potential of losing $59,000, another $27,000 beyond the 32 that he was already showing on his P&L. Now, the punchline of the story is that he ended up making $9,000 on the trade. And that's because while he was away on vacation, the market bounced, and it did indeed bounce right back into the profit zone of his trade, and he ended up making $9,000 on the trade and closed it when he got back from vacation. Nonetheless, during our mentoring session, I was very critical of this trade. I look for discipline and process with our traders, not whether you made or lost money on any particular trade. Whether you made or lost money on a particular trade is a minor point in the development of a trader. The major stuff is the blocking and tackling. The major stuff is the process, the establishment of a high-quality trading protocol, and then following that protocol. That is what makes a successful trader in the long run. So after the trader finished, and of course it was good-hearted, but I did say to him that this reminds me of Mr. Magoo. Now, those of you who are old enough to remember who Mr. Magoo was a fictional cartoon character in the 60s who was blind, yet somehow drove a car. And in the introduction to the show, he would drive through unbelievably dangerous situations, driving off of cliffs and going through red lights and hardly hitting, barely missing, getting into major accidents with 18-wheelers and so forth. Meanwhile, he's happy as hell driving his car through all these dangerous situations and ultimately reaches his destination very happily, never understanding the danger that he was in and not really caring about that danger because he's blind, he didn't see it, and he didn't know any better. Well, that trade that this trader did the fact that he made money on it was what I would call a Mr. Magoo trade. Somehow he ended up happy at the end, even though his process was really problematic. And number one, let me list the ways. He went on vacation without having any plan for what would happen if the trade went bad. He neither closed the trade, which would be the most sensible thing to do, or at least give instructions to another trader who he has a compatriot of his who he has a relationship with and trusts to handle the trade appropriately while he's away. So he had no way of closing the trade. The trade went past its stop. He had no way of addressing it, and it went way, way, way past its stop. This is a trade where your stop is $15,000. He was already up to $32,000, and if the market had continued crashing, he would have ended up with a $59,000 loss. So he had to rely on hope for this trade to come back. Well, that's not really good trading. He made $9,000 on the trade, but that was really irrelevant to my analysis of his process. The process was not a good process, and in the long run, running your trading business like that will end your trading business. You will not have a trading business because you did not conduct the proper risk management on your trades. If the market had not come back, he would have been down $59,000. It could take quite a long time to make that back up. So the lesson here is making money on a trade is not even close to being enough in terms of developing yourself as a trader. In any given month, you can make money or lose money on a trade, but the development of a proper process will help you to be a sustainably profitable trader in the long run. Remember, if you take your stops, you'll live to trade another day. If you don't take your stops, now you're just relying on luck and hope. And no good business, no good trading process relies on luck. Rather, it relies on solid planning and solid execution of that plan.